After the autumn statement on this side of the Atlantic and Thanksgiving on the other, December beckons, but the news flow will continue to come thick and fast. An OPEC meeting on Sunday the 26th of November will be interesting in the context of the latest slide in oil prices, which some are interpreting to mean a global slowdown or recession may be on the way. Meanwhile, the latest monthly mortgage approvals data here in the UK on the 29th could be informative too, as markets try to assess the economic impact of the string of interest rate increases pushed through by the Bank of England over the past 2 years. But the main macroeconomic story of the week just could be the Conference Board's latest monthly US Consumer Confidence Survey in America. That's due for release on Tuesday the 28th, and in the light of a profit warning from Walmart, a gentle increase, albeit from low levels, in weekly initial jobless claims and a rotten reading from the NAHB House Builder Survey, it should be particularly timely. Personal consumption represents around 2/3 of US GDP, so what American consumers are thinking, doing and spending really matters to the world's biggest economy. The reading for October from this Conference Board survey was 102.6. The number itself doesn't matter, but it was the third consecutive month-on-month decline and was broadly flat on the same month the year before. However, even that was a long way down from the post-pandemic high of June 2021 and even further below the pre-COVID all-time peak of 2019 when some chap called Donald J. Trump was president. Now, I guess we can put that longer-term decline down to inflation, higher interest rates and higher mortgage rates. House price inflation has slowed, and even major US stock indices like the S&P 500, Dow Jones and the Nasdaq still trade below their 2021 peaks, which may, to some degree, be influencing sentiment and spending plans too. And on that topic, you could argue, if you wished, there's a link between consumer confidence and the US stock market, at least as benchmarked by the S&P 500. Which leads, which follows, will remain a matter for debate, and we must accept that correlation doesn't necessarily mean causation either. But if one of them falters, then there could be a degree of reflexivity here, which may mean the other one wobbles too. Back on the home front, just two FTSE 100 firms have an announcement scheduled for the week ahead, and they are both analyst meetings which may or may not feature an update on trading. There is, however, a long list of mid and small caps due to report full year or first half results or release a trading statement, and names which may be worthy of further study include the following, pending any late changes in the dates. Bolex on Monday the 27th of November, Rolls-Royce, EasyJet, Topps Tiles, Greencore, IG Design, Renew and GB Group on the 28th, Halfords and CVS on the 29th, Beasley, Dr. Martens, Mulberry on the 30th, and Auction Technology on Friday the 1st of December. But the company which could really cause the biggest fuss in the week ahead hails from the FTSE 250, and it is Pennon. The utility, which runs South West Water, Bristol Water and Bournemouth Water, is scheduled to release first half results on Wednesday the 29th. Pennon shares are down by a fifth over the past year. Rather like Severn Trent, which we studied last week, sentiment towards this stock has been dampened by the collapse of Thames Water, public outcry and regulatory blowback over sewer flooding, pollution and stormwater overflows, preparations for the AMP8 regulatory cycle, which runs from 2025 to 2030, and the effect of higher interest rates, which are twofold. First, Pennon has £3 billion of debt, and around a third of it's index-linked, so as interest rates go up, so do interest payments on that portion of its borrowings. And second, stock markets tend to treat utilities as bond proxies, since fixed income's all about yield and income rather than capital return, and utilities don't grow that quickly either. So the higher the bond yields go, the more attractive fixed income looks relative to utility equities and vice versa, just because of the yield comparison. Unlike Severn Trent, which is boosting its income from outcome delivery incentives or ODIs for beating its regulatory targets, Pennon is losing income for underperforming them. And in Ofwat's autumn review, South West Water was described as an average performer by the regulator, and Bristol Water was lagging. No one, by the way, was deemed to be an outperformer. South West Water submitted its AMP8 proposal to the regulator in October and hosted an analyst meeting shortly after to outline its plans to analysts and shareholders. So the focus here on the results is likely to be just the figures themselves and how they stack up relative to the company's guidance for the full year. That was given alongside last year's annual results in June. And the key points here were an increase in sales thanks to higher tariffs and prices, higher operating costs thanks to upward cost pressures for staff salaries and wider inflation, a higher interest bill and a higher tax rate. That combination turned into Chief Executive Officer Susan Davies' forecast for, and I quote, an improvement in near-term earnings, and Pennon's targeting long-term growth as well. There's £2.8 billion in capital investment between 2025 and 2030 under AMP8, grows the regulatory capital value, or RCV, of the firm's assets, and it operates within preset price limits. Now, Pennon has noted that profits will be second-half weighted as it starts to generate synergies from the Bristol Water deal, but analysts will look to these results for a feel for the accuracy of their full-year forecast. 10% sales growth and a statutory pre-tax profit £23 million against last year's loss of £8.5 million. A further big number to note is capital expenditure. Management's flagged an increase from last year's £354 million, and the AMP8 budget implies much higher numbers again going forwards. And despite the higher spend, Pennon is committed to raising its dividend at AMP7 by the CPIH rate of inflation plus 2%. Last year, Pennon paid an interim dividend of 12.96 a share, on its way to a total distribution for fiscal 2023 of 42.73. Now, the company's run share buybacks in the past as well, particularly after the sale of wastewater treatment business Viridor in 2020, when it also paid out a big special dividend. Hope that you and your family enjoy good health and good spirits. Thank you for watching, and I look forward to seeing you again next time.